good afternoon or good morning to everyone on the webinar today. I appreciate you calling in or looking in today on our webinar. We're going to talk today about investing in notes. We've brought in a guest speaker today to talk to us, really to go through some of the more basic aspects of investing in notes, and certainly we'll talk about how to do that within your IRA account. But we're happy to have Patty Pett on today with Ader Financial, who's going to talk in a few minutes. Really kind of going over note investing, really starting at the very basic level with some definitions and some understanding, and then kind of ramping it up a little bit further into more information on this type of investing in, whether it's in your IRA or not. Going to have some great content. So hopefully if you're listening today, you're going to find out a lot about how to invest in notes, how to get started, and exactly what it is. That's the goal of today's webinar, is really just to provide this great educational content as we go forward today. Now, if you're listening live to the webinar today, you have the ability to ask questions by typing your question into the chat box on your screen. So just type those in as they come up, and I'll make sure that either myself or Patty gets your questions answered. If you're someone who's listening to the recorded version of this webinar today, my contact information as well as Patty's information will be present in the webinar for you to jot down and then give us a quick call after the fact and see what we can help you out with. If you can't watch, obviously watch it live and you're watching the recorded version. My name is Scott Malar. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now and focus primarily at this point on the business development in both our Atlanta and Tampa offices, and certainly with working with people throughout the United States as well. Now, a quick just introduction on what Advanta IRA is. We're a self-directed IRA or retirement plan administrator. We serve clients nationwide. We have clients who are obviously a lot of them in our Tampa or Atlanta markets or close by, but we do work with people all over the country. We purchase assets, whether it's real estate or notes, all over the country as well. So if you're kind of new to Advanta or new to self-direction, give you a little more information about us here as well. Again, we are a self-directed IRA administrator, which means we provide a service of holding alternative assets within a retirement account. We do not sell any products. So we don't sell real estate, we don't sell notes, we don't sell gold or silver. We provide a platform for you if you would like to invest in some alternative asset. We provide you the platform to be able to do that in holding these alternative assets. And we do so by providing really a concierge type service for all of our clients and all of our investors, that the person you get assigned to when you open up an account with Advanta is the person that is going to help you throughout all aspects of your account and each transaction that you do. So if you're investing in a number of different notes, you're going to work with that same person at Advanta every single time. They get to know you, you get to know them, make the process work much more smoothly and quickly as well. We also like to provide a lot of educational content. Now, today's webinar is just an example of the things we do here at Advanta. We try to promote ourselves and promote our services and promote self-directed IRAs through educational offerings, whether it's a live seminar in either our Tampa or Atlanta office, or you could try, obviously participate in these webinars today. We do live networking events sometimes as well. So we have an on-demand site. You can go to our YouTube page, can look at any other old webinars that we have done as well. We want people to be educated and understanding about what it is that they are getting involved in when they're deciding to self-direct their retirement account. Now, why haven't people heard of self-directed IRAs? Very quickly, the reason why, because your bank or your brokerage firm where your 401k or your IRA is located, they are not offering this as an investment to you. They only sell you at those accounts those things that they're willing to hold. So the only things you could have in an IRA account with a brokerage firm is a mutual fund or a stock, something that they're actually going to sell. But IRS regulations allow for a very broad range of different investments that you can hold in your IRA. You just have to have a custodian like Advanta who's willing to hold these alternative assets. So the IRS will say you can invest in real estate, you can invest in notes, but each custodian can decide what they're willing to hold. And your current bank or brokerage firm is not going to hold something that they don't sell. It'd be akin to McDonald's has made the decision not to sell tacos or not to sell pizza. That's not their business model. Their business model is burgers, fries, and shakes. If anyone saw the movie The Founder, that's how they got started on those three items. So again, so that's why a lot of people haven't heard of self-directed IRAs, because they're not going to offer you things that you can, at a brokerage firm, that you can't buy through them. Now, the types of accounts that can be self-directed, if you have any type of IRA, whether it's a traditional or Roth, a SEP, or a simple IRA because you're self-employed, you can have a solo 401k, these funds can be utilized into the investments that we hold at Advanta and what Patty's going to talk today when we talk about investing in notes and investing in real estate, different things like that. As long as you have, if it's an IRA, there's no doubt you can move that money. And again, if you're self-employed, opening up a solo 401k or perhaps a SEP or simple can give you larger contribution limits. Now, to find out more about these types of accounts and the background on those, please give us a call. I'm not going to go into detail today on the webinar for this, but I'd be more than happy to talk to someone individually. Now, if you have money in one of those accounts, you'd like to self-direct it, like to make an investment into a note, it's very simple. You can either transfer the money, you can do a direct rollover, you can do an indirect rollover. Basically, you can move funds from your current account to an Advanta self-directed account with no tax consequence. You can move as much or as little as you want, and you can move money back and forth between accounts as often as you'd like. And it's important to note that the transfers, direct rollovers, and then when we start talking about earnings, the interest you're earning on a loan, the profits on a real estate sale, et cetera, that is all unlimited back into your IRA account. So again, moving money between accounts is very simple. That's what we help with here at Advanta IRA in that process of getting started. Now again, the types of assets that we see at Advanta, a lot of them are real estate based. I'm sure Patty's going to talk, tie real estate into the notes that we talked about today as well. But your IRA can buy actual real estate, whether it's a residential property, whether it's a commercial piece of real estate, whether it's vacant land, whether it's a property that you're looking to flip, whether it's a property you're looking to rent out. All of those things can be done within a particular, within your IRA account. And the only caveat with real estate is it does have to be for investment purposes only. You cannot buy property in your IRA that you want to live in, that you want to vacation in, or that certain members of your family may want to use or rent from you. There are some restrictions with that. But if you're buying from third parties and it's strictly investment property, there's really no limit to the different type of real estate you can buy and maybe what you can ultimately strategize with, again, whether it's a flip, long-term or short-term rentals as well. Now, in addition to real estate, we also hold a number of paper assets, investments that aren't the brick and mortar of real estate, but the investment could be a signed note, could be a signed mortgage loan. So the asset still might be backed by real estate. You still have a piece of property as collateral, and again, Patty's going to get into what all these words are here in just a few minutes. But your IRA can be the lender, it can be the bank. And in fact, we do a separate webinar just on IRAs and lending. We call it Be the Bank. We're using your IRA as a private lender where you can put to use what you're going to learn today within your particular IRA account. In addition to real estate notes like mortgages, people invest in the tax liens, unsecured notes, debenture notes. You can do option contracts or assignments. You can joint venture with people. But again, these investments all have in common it's a piece of paper. Whether someone signed a promissory note, whether someone signed a mortgage to your IRA account, that's the actual investment, is the piece of paper. It's not necessarily the house or the office condo. That is the collateral for your loan. We see a number of people investing into these types of assets as well. When we talk about private lending, again, we do a presentation called Be the Bank. But any type of loan, whether it's a traditional mortgage loan, what you and I might be familiar with when we buy our own house or buy our own condo, where you buy the property, the bank lends you the money, you sign the mortgage over to them, and you pay it back over 15, 20, 30 years. There's short-term transactional funding, maybe even shorter term, maybe even 6-month type of funding. You can do unsecured notes. Again, we're going to talk today about is secured notes with real estate, but it is possible under the IRS rules for you to lend money to somebody, and they just sign a simple promissory note to you, promising to pay back to your IRA account. You don't have to have collateral. That's not an IRS requirement. It's definitely something that's riskier, and you want to think about a lot before you get involved. But that's certainly something that can be done as well. Again, equity participation. You can secure your notes with other assets than real estate. We've had people use farm equipment, automobiles, and livestock as collateral for a loan that their IRA made. Now, when you're lending money out of your IRA, and in many circumstances, if you're lending to just a third party, you get to control all the note terms. This is why we call our presentation in one respect Be the Bank, because you are the bank, you are the lender. deciding how much you're going to loan, what that interest rate looks like, what the length of that note is going to be. When is it? Is it 10 years, 5 years, 30 years, etc.? Whether it's amortized or interest only. Are there any equity participation terms, etc.? So all those terms that go into making a note, making a mortgage, are up to you. And the benefits really of private lending, again, Patty's going to cover a lot of this in more detail, but acting as the bank and determining the terms, you're setting the rate at which your IRA is growing. If you know you're lending money at 8, 9, 10%, 15%, you know exactly then what your account is growing at. So at this point, I want to bring on Patty Pedd with Advanta Financial. She's going to tell you a little bit more about their company. So Patty, go ahead and take it over.
Great. Thank you, Scott. Wonderful to see you all here. Thank you so much for joining us today. We're very excited to talk to you about notes, what they are, and how you can benefit from them. Let me pull up the slides real quick here.
Yep, and while Patty's pulling up the slides, I want to just remind everyone that's listening live, if you have a question for Patty or myself, please type it into your chat box on the screen. We'll make sure we get that question answered.
Absolutely. Can everybody see my screen?
Yep, well, I see it just fine.
Perfect. Great. Again, welcome to Introduction to Note Investing. Just a little disclaimer here. This material available here is for educational and informational purposes only and should not be construed as legal advice. Just a little bit of background about Advanta Financials. Oops. Sorry, just give me a quick second, please. I think it's trying to do the slideshow. Let me try this. This is going to make sure it's a manual one. Okay, here we go. Sorry about that. Oh, that didn't work. Okay, hopefully this is going to work. Okay, so just a little bit of background about Advanta Financials. We are a nationwide private mortgage investment company. We buy residential notes and we use them for our own portfolio. We are privately funded. We have investors who do joint ventures with us, and our small size allows for a high level of service and flexibility in our service. We work with many different aspects. We work with investors, banks, realtors, and other members of a power team. I'm going to go into a little bit of detail about what a power team is in our next slides. But our power team consists of banks, realtors, and other members that are essential to our real estate note business. Our mission is threefold. We work with homeowners, investors, and lending institutions. For our investors, our goal is to achieve high returns, and for our homeowners, we offer unique solutions for all of their mortgage difficulties. And for our lending institutions, we help them by liquidating their non-performing or non-accrual assets.
Hey, Patty,
so let's talk
really quickly, if I can interrupt, the Ready Talk
Sure.
bar is covering some of your slides. If you can just move that bar a little bit out of the way.
Oh, I don't know if you could see the bar, but thank you for letting me know, Scott. Oops.
Nope, no, you kicked it back to,
yeah.
Here again, I'm sorry, that bar was
Okay.
covering up some of the slides.
Sure, so I got to share again, I guess, right?
Mm-hmm. Yep, just click on share.
Okay, there it is. Okay, let me see how okay, minimize these controls. There it is.
Yep, perfect.
Thank you.
Okay, sorry, go ahead.
No, that's fine. So what are we going to talk about today? First, we're going to see how you can transform from a landlord to what is called a lien lord. Then we're going to talk about notes, what exactly they are, why you should invest in them, and how the whole shebang works. And then we're going to go over 10 necessary steps for profitable note investing. We're also going to talk about one of the most important steps for a note buyer, which is the due diligence phase and what each of them contains. And then we're going to talk a little bit about how to get started in real estate notes, what your power team needs to be, We'll also go over some case studies and current deals that we're working on, just to give you a little bit of idea about what you're looking at here. We'll also have some time for questions at the end of the presentation as well. But feel free to keep asking questions as we go along so I can answer them as and when. Okay, just a little show of hands. How many of you here on the call right now are real estate investors?
Yeah, and for people, if you want, you can either click the button to raise your hand, which looks like a number of you are, or you can also type in your chat box as well. So yeah, Patty, there's a number of them with their hand raised.
Okay. So where can I see where their hand raise are?
There you can.
Oh yeah.
If you can.
Hands raised 12. Okay, I think I see them here. Great. That is wonderful. So out of the people present here, at least 12 of you are existing real estate investors, and I'm glad to hear that, because this is going to be more informative and applicable to you all. Just like you, I started with real estate. I started with a multifamily unit. I bought it from my own personal funds, and this was based in Pennsylvania, and that was one of the best deals that I had done in regular real estate. It being multifamily, it afforded the security against vacancy. That means if one of the units was not rented, the other one would still bring me good cash flow in order to pay my mortgage every month. So this was a good rental property. It was located in a great neighborhood. And using this monthly cash flow, I was able to add a few more rental properties to my portfolio. So everything was going well. Now, that was the good part. And what was the bad part about it? You probably already experienced this, the 2 a.m. calls about flooding in the bathroom, the maintenance, tenant complaints, inspections, going to eviction court, and spending much more money than I actually intended to. It was actually getting to be too much of a hassle, and it was eating into not only my cash flow, but most importantly, my time. Instead of making the money work for me, I felt like I was working for the money, and this was not something that I intended to do long term. So I started looking at alternative investment options, and in 2013, I learned that just as a bank can issue a loan and make a profit through interest payments, an individual can also do the same and become a private investor or a hard money lender and lend money to borrowers who will then make monthly payments to him. And the best part was that the banks not only give out new loans, but they also sell these defaulted mortgages to investors at a huge discount. So I started digging deeper. I started to learn a little bit about what these terms mean, and especially what mortgages are, notes are, and this is what I found. So what exactly is a mortgage? If you look at this diagram, it's pretty simple, and most of you here might already have a mortgage with a bank right now. A mortgage is a right to collect from a property. It creates security by creating a lien on the property. There may be multiple liens on the property, and the order of the lien is dependent upon the order in which it has been recorded in a county. A mortgage and an assignment must be recorded. So when you're ready to buy a property, you would first look at the property. The borrower then approaches the bank, and the bank then approves the loan. So the cash would be released, and then the borrower would go back and purchase or close on the loan, close on the property, and he would then become the owner. So just what I was talking about, the mortgage and the assignment must be recorded. A mortgage gets recorded to secure your lien position, and an assignment is also called the assignment of mortgage, which represents or shows the lien transfers between one lender and the other. And these two are recorded at the recorder of deeds at each county, which maintains a record of all of these mortgages. So where do we come in during this process? After receiving money from the bank and purchasing the property, The borrower starts making monthly payments to the bank, and the mortgage is now secured, and it is now called a performing note. But due to any unforeseen circumstances, if the borrower stops making payments to the bank, this now becomes a non-performing note. The bank would now start looking for buyers so they can offload these deals and still try to make some profit off of them. And now let's look at notes. A note is a promise to repay a loan, and hence the term promissory notes or IOU. In real estate note business, a note is in the form of a contract where the borrower agrees to pay a certain portion of the loan to the lender within a set time frame under specific terms like interest rate, repayment terms, penalties, etc. There are many different types of loans. You have HELOC loans, fixed loans, balloon loans, where the borrower pays a lump sum at the end of the maturity of the loan, etc. Now, when a note is transferred between lenders, we have something called an allonge to the note. This allonge it represents the transfer of the note, the ownership of the note from one lender to another. An interesting thing to note here is that a note and an allonge to the note do not get recorded in the county, and they can only be obtained from the lender who originated the loan and the seller who has bought the loan from the previous lender. An allonge is an addendum to the note, and it always has to be attached to the note, and it always has to be together. And this specifies the transfer of the note between various lenders. Having a good and clear chain of title is a very important aspect of a good note.
I was going to say, Patty, just to clarify too for everybody, the allonge is signed not by the borrower. It's signed by, in your instance, it's signed by the bank, basically almost like assigning the note to the subsequent purchaser, correct?
Right. The actual mortgage and the note are signed by the borrower when the loan was originated, but then the allonge and the assignment are only transactions between the lenders, and it has nothing to do with the borrower.
Okay, and if anyone else has, again, if you have questions, please make sure you get those typed into the chat box as Patty goes along. All right, thanks, Patty.
You're welcome. So why are we looking at notes here, and what are the differences between being a landlord and a landlord? A landlord, as you see, it's very cumbersome. You have to be actively involved in a lot, and a lot of time and energy are required, and most of the time you're constricted to working with local deals in your area. So you can go back and forth, take a look at the properties, manage them, and real estate business is also heavily dependent upon the market conditions. And the worst part is that there is no collateral and there's no security in being a landlord, because if something happens to the house, it's your loss. On the contrary, if you are a landlord, this is a great source of passive income. There is high cash flow. You have equity from the market, and the market fluctuations do not affect you in any manner. In fact, the more there are defaulted mortgages, the better your business will be. There's a lot of versatility in terms of what you can do with the notes, as we will go through in the next few slides. The most important thing is that these are secured notes and they are backed by collateral. So if the if the property owner stops making payments on the mortgage every month, then your investment is secured by the property itself. So you always have the opportunity to possess the property as your security for the investment. The whole process of obtaining notes is very simple, and it has very little risk involved, as long as you do your due diligence correctly. And as you can see, it's much easier to maintain a portfolio of 100 loans as opposed to maintaining a portfolio of 100 real estate assets or properties. The most important thing in being a landlord is that you have the opportunity to help the homeowners in keeping their homes and start making payments to you. You have multiple exit strategies, as we will go through in the next slides. You can provide them with solutions that the bigger banks usually cannot, because you have much more flexibility in what you can offer to them. So this is just a little bit of glimpse into the history of stock market. For those of you who have been involved in stocks and bonds, you know how volatile it is, how unpredictable it is, how much active work is involved in keeping track of the stock values every day. And the worst part is that there is no collateral or no security for your investment. If you lose your money, you lose it once and for all. On the contrary, how stable is the supply of notes? Reality Track reported that at the end of 2014, there were still more than 7 million residential homeowners seriously underwater in this country, representing 13% of all the properties with a mortgage. Can you imagine having 13% of all the mortgages being defaulted? Underwater here means that the amount you own on your loan is much more than the value of your property. So these underwater homeowners mean that the supply of real estate notes is going to be steadily available for the next many years to come. Some key definitions in the note industry. The first one we're looking at is what is called a performing note. This is when the bank initiates a loan and the borrower has been making payments on a regular basis, but it is not more than 90 days past due. A non-performing note is a loan that is in default or is close to being in default. And as the name suggests, the loans have not been paid for more than 90 days. Sometimes even years pass by before the borrower is even contacted to make these payments. A reperforming note is when an investor goes after a non-performing note or a borrower with a non-performing note and negotiates with them and has them start making their monthly payments again, which then makes it a reperforming note. A collateral, as we talked about before, is the property itself, which is the mortgage that we have on the property. It secures the mortgage and provides a lien on the property. Now, there are two main mortgages. The first one is obviously called the first mortgage, and then the second mortgage. They both use the house as the collateral, but the first mortgage has the primary claim on the property. It takes precedence over all other subsequent claims, which are also called junior claims. If a borrower defaults on the loan and does not pay the debt, then the property can be sold to satisfy the debt. In such a case, the first mortgage has the primary claim on the property and it will be paid first. The second mortgage is what the banks called HELOCs or home equity loans. This allows the homeowner to tap into the home equity to borrow money rather than take out a separate personal loan, and then they can use this money for home renovations, business capital, any other expenses related to their property. For example, if a property is worth $100,000 and the first mortgage on the property is at $70,000 and the second mortgage or the HELOC is around $20,000, in case the borrower stops making payments and is not interested in keeping the property anymore, the property would then be sold either at a short sale or at a foreclosure auction. And if the property yields around $100,000 for what it's worth, then the first mortgage, which is the $70,000, gets paid first, and then the second mortgage, the $20,000, gets paid second. And once again, it is the order in which the mortgage has been created and not the amount of the mortgage which determines the first and the second liens on the property. Now let's talk about the life cycle of a note. So this, if you look at this diagram, at the time of the purchase of the property, the note is originated by the bank using set terms like interest rate, the amount of the loan, the payment term, penalty for prepayment, those kind of things. As long as the borrower is making performing monthly payments, it's called a performing note. At the end of the life cycle of a performing note, the borrower either chooses to pay off the entire loan or he would ask for refinancing. Now, sometimes the borrower stops making payments and the loan then becomes a non-performing note. At this stage, an investor can purchase the note and become the new owner of it. He now has several options that he could provide to the borrower. He could try to do a loan modification, which, as the name suggests, modifies some of the terms of the agreement, like reducing the interest rate or the monthly payments or increasing the term of the loan, etc. In this case, it then becomes a reperforming note, like we talked about before. And it would follow a similar path. At the end of the life of the loan, the borrower could either pay it off or he could refinance it. If the borrower does not intend to keep the property, he has two options. He could either sell it, or the bank would generally sell it, or the new investor would generally sell it as short sale, and they could use those proceeds to pay off the loan. If we are unable to contact the borrower and if the borrower has been non-responsive, then the bank can also foreclose on the property, and the proceeds again would ensure that the loan has been paid off. And this actually goes back to what we were talking about the first mortgage and the second mortgage. So at the time of foreclosure, the first mortgage gets paid first, and then whatever is remaining equity, that gets paid to the second mortgage and all the other junior liens that follow. So how do the notes transfer ownership between the lenders? When purchasing a note, there are four main components that you need to make sure or ensure that happen in order to maintain a legal record of the transaction. First, you would receive the collateral files, which would include the mortgage, the note, and all the other information from the current seller. Then the assignment of mortgage is made out to your company, and it is recorded with the county office, which is the recorder of deeds. And a launch is made in your company's name, and it would be endorsed or signed by the seller, which notifies the borrower that their monthly payment should now be sent to you and your company. When I say company here, it doesn't necessarily have to be a company or an LLC per se. It could also be an individual investor. The last step in this process is to send RESPA and TILA letters to the borrower to notify them about the change of ownership of the note and the mortgage. RESPA here indicates the change in loan servicer, and the TILA, which is the Truth in Lending Act, describes the change in ownership of the actual note itself.
Yeah,
now that you are the
Sorry,
go ahead, Scott.
Sorry, Patty, I had a couple quick questions to ask going back. I think it was maybe a slide or so ago. But
sure.
Someone says, does a mechanics lien take precedence over mortgages? And then also, and then somebody else asked about property taxes. Don't they get paid first in a foreclosure situation? Maybe address those two, and then I have another question after that.
Sure, that is correct. So depending upon the order in which the liens have been placed, especially when it comes to mortgages, the first mortgage gets paid first and then the second mortgage gets paid. But if there is a tax lien on the property, you're right, the tax lien gets paid first, and then it comes the turn of the mortgages.
Okay, and then but the other one was a mechanics lien. So I'm thinking like you have a roofing company puts on a new roof. Does their lien on a property take precedence over a mortgage?
I think it depends entirely upon each county and each state. They have different rules. In some states, they also have HOA fees. They're called the super lien states, where the HOA guys get paid first, and then it's the turn for the mortgages to be paid. So I think it's entirely dependent upon the state and their regulations.
Okay, and then one person had a couple of questions. We'll see if we can get a couple of them. So I think you're probably talking about this, but your experience in dealing with non-performing mortgages. But what are some of the costs related to these non-performing mortgages, especially specifically legal fees in the case of a foreclosure?
So we do have a little bit about that in our next slides. I will be going over some of that, but just to give you an idea, usually it would be the cost of servicing the note, and you have ownership and encumbrances report that you would look up during your due diligence phase. You have some realtors who would go in and take a look at the property for you. So you may have to pay for the BPO for that particular asset, so you know the current value of the property and the condition. And you also have attorney costs and attorney fees, and costs involved in order to initiate foreclosure proceedings. So the costs, again, vary for each state because of the number of months, or the timeline for each state is different for foreclosures. And most of the attorneys that you would work with would follow Fannie Mae guidelines. So all of that information of how much it would cost for an attorney and the costs involved would be readily available online. So you can look them up, and you would have a pretty good estimate of what your costs would be even before you purchase the note.
Okay, and the last question, again, this might be something you're going to cover here in a minute, but kind of the experiences in buying a non-performing note or mortgage in judicial foreclosure states versus non-judicial foreclosure states. Again, if that's something you want to address now or later, but that was another question that just popped up.
Sure, we can talk about that now. In our experience, since we've dealt with so many notes so far, it is not very different. We are actually working with a non-judicial state right now. The process is very different, and the amount of time it takes is also different because non-judicial states definitely take much shorter time for the foreclosure to come to fruition or for the sale date to be given out. But other than the timeline, in terms of the process or in terms of we definitely didn't see much of a difference from our end. And when we do our calculations, we have strict numbers or estimates based on how much it would cost in each of those states. So we factor it in when we are trying to calculate our profits or ROI from it. And so it hasn't really, we don't differentiate between the two of them, but some people generally prefer non-judicial states only because of a shorter timeline and considerably, I wouldn't say considerably, but a slightly lesser cost than you would experience for a judicial state.
Thanks, Patty. And good. Great questions from the attendees. Keep them coming as Patty continues to move on.
Great. Okay, so what can you do? Oh, I think we were talking about this. So now that you've become a note owner, what can you do with it? Just like real estate, a note can be flipped, which is called wholesaling in the note business. You can purchase a note and you can immediately sell it to somebody else at a quick profit. The note can be rehabbed, it can be borrowed against, and it can be leveraged. A little bit more in terms of exit strategies that you can provide for your borrowers. If your borrowers intend to keep their home, you would provide them options to modify their loan, or if they want to reinstate their loan. You can also provide them with some kind of repayment plans. You can say, over the next 90 days, you can pay us, $5,000 a month kind of thing. So you can provide a repayment plan so that your borrower doesn't feel like he has to pay a huge amount upfront. You can also provide a discounted payoff. If the loan is, say, $25,000, you can say that if they are willing to pay off within the next 30 days, you are willing to reduce the loan to, say, $22,000 or $20,000. And these numbers, again, come from your spreadsheet, which would contain all of the information about the loan, where you would have all the calculations about the ROI and how much profits you're expecting from it and what your JV investor is expecting from it. If the borrower is not interested in keeping their home, you can sell the property at a short sale, or they can sign it over to you using a deed in lieu, or they can also have somebody assume their loan and you would actually have a separate agreement with the new borrower or the person who has assumed the loan, and which would then become a reperforming note, and you can get the property. You can also provide some kind of seller assistance in order for them to continue their, actually it's called cash for keys, and other terms are used in the note industry that you can provide for them. Okay, so now we talk about the 10 steps to profiting from notes. Step 1, as you know, is that the property is sold and a note is created by the bank seller. The bank, or he can also be the seller. Step 2, the note becomes a non-performing note because the borrower has stopped making payments to the bank. At this stage, the bank is now trying to look for buyers who are interested in purchasing the note. Step 3 is note and worksheet, which will be presented to the buyer who is looking to buy the note. They will be looking at each and every aspect of the note, and they'll try to understand where it's coming from, how much the expenses are in order to maintain the note, and what profits can be expected. In the investment analysis phase, you would look at the numbers for multiple exit strategies, and you would analyze it for the best and the worst case scenario. So we have a thorough understanding of the financial aspects of the note before we purchase it. Just a little more information about step 4, if we step out of this for a little bit, which is also step 8, but I'll go over that in a minute. So step 4 is one of the most important steps, which is the due diligence phase, in where we look at various factors like the equity in the property, the value, which is obtained from a realtor, a local realtor, who can drive by the property and who will provide information about the current condition of the property, the neighborhood, what these, if it's a seller's market or a buyer's market, what the rents are like, what if the property needs any repairs, what the estimated cost would be for the repairs, what the after repair value would be, if the property is actually occupied or not, because sometimes these borrowers have already given up on their homes, or it's their second or investment property, so they're no longer living in the property. So you need to know the occupancy status of it so you can determine the amount of repairs it needs once you possess the property. And we also get some drive-by pictures which which also explain the current condition of the property. We also do a quick title search, or an O&E report, which is the owner and encumbrance report. It would give you what kind of liens are on the property, which also includes the HOA liens, the tax liens, any junior liens that are on the property. So you kind of get a basic overall view about the property itself, and if the taxes are being paid on time or not, and all of that information in there. And then, like we were talking about, we also look at the taxes. We go on the county website, we pull up the current tax information, and we see when it has been last paid. And as somebody asked, sometimes there are some tax liens on it because the taxes haven't been paid for a long time. So we try to use that number in our calculations so we know how much we need to spend in order to pay off the tax lien and protect the property. Then we also have HOA fees. Some properties are in neighborhoods which have a homeowners association, and these require fees every month or every year, depending upon how they're structured. And if these fees aren't paid on time, there are specific states which require which actually allow the HOA to place a lien on the property, which supersedes all the other liens that are on all the other liens in terms of mortgages or anything else. So when we do our due diligence, we try to find out if there are any HOA fees, unpaid fees, or if there's any liens on it. We also look at the location and comps, which are as you real estate investors have already seen, are the numbers that are given to us by our local realtors who try to see the number of sales within the last 12 months or 6 months in the area, so we get a sense for how much the property is worth. And for second mortgages, if we are purchasing a second mortgage, we try to look at the credit report, which is very important because it gives you a glimpse into the financial situation of the borrower and how responsible they are with their money. And then we also look at the borrower's pay history over the past few years. We always request the seller to provide us with the pay history because that is very important to know if the borrower has been making payments regularly before he stopped making the payments, because again, that would get us some kind of information about who the borrower is and how financially responsible they are. So based on all of this information, we would then put in an offer or a purchase price bid and send it to the seller. The next step would be negotiations with the seller. We would talk about the offer price and why we think that would be a good price for that particular asset. The seller would then try to negotiate, and they would come with their offer, and it would go back and forth. And this option would be executed only upon acceptance by the seller. Once the offer has been accepted, the documentation or the collateral that we talked about would be sent to the buyer. The buyer would then review all of this collateral, and they would make sure that the chain of title is perfect, the assignments and the allonges all line up, and there is no break in any of the chains, so that if it comes to proving your ownership, you would have a clear title and no other legal complications. This is again a little more detail into the due diligence that was performed in step 4 that we just talked about. After the initial due diligence, you would then go back and talk to the realtors. You would pick up the phone and call the utility companies, find out if the utilities are being paid every month, and all the other important steps that would give you a complete and comprehensive view about not just the property but the borrower also. Once the due diligence has been completed, if you feel like everything is satisfactory, you would then close the transaction, which would initiate the seller to send the documents to you, and this would usually be a wire transfer where you would transfer the money to the seller, and there would be a note sale agreement that you would sign, and they would initiate service transfer, where the servicer would then get the information about the loan and and the pay history, the servicing history, and any other comments that they have about the loan. So the IRA investor usually comes in at step 9. So usually we perform all of the due diligence. We make sure that all of our numbers are working correctly and that we are getting at least 30% yield on whatever asset we choose. And once we have done all of our thorough research, we try to contact our IRA investors who have registered with us. We let them know about a specific deal. We give them a copy of all the information that we have so far about the property. And once the IRA investor is interested in it, they would then wire the funds into our account, and we would then wire the funds to the bank, and the transaction would be closed. Scott, how are we doing on time?
We're doing good. I want to get a couple quick questions in here before we get to you. You have time
Sure.
for the last few slides.
Okay.
Someone just want to know when a note owner forecloses on a home, so it goes to auction. if the auction price is over and above what's needed to satisfy the liens, the mortgage and any other liens, who gets the extra cash? Does that go back to the actual homeowner and original borrower?
Yes. So that's a great question, actually. So at the auction, it could go two ways. If it's an underwater loan or underwater note, what would happen? Let me use numbers so it's easier for us to talk about. So if the property is worth $100,000 and the lien or the first mortgage on it is for $50,000, and I'm talking not just about the unpaid principal balance, but the actual payoff, which would include the arrearages, the unpaid late charges, the unpaid interest, and everything else up to that point. So if you can imagine the payoff to be about $50,000 and the sale proceeds are about $100,000, the first mortgage would first be paid off the $50,000, and if there is a second mortgage for say $20,000, the second mortgage is then paid the $20,000, and whatever is remaining, the $30,000, that actually goes back to the homeowner if there are no other liens on the property.
Okay.
If it is an underwater property, though, what usually happens is that we would quote a payoff of $50,000, and if the property is sold for say $40,000, then you have an option to say that you do not want to sell it at that auction because your loan payoff is not being met. So what happens is that you become the current owner of the property because your lien is the first mortgage. And what you can do at that point is you can have a realtor or a property management company go in and fix it up a little bit, and you can actually place it on the regular market and sell it for the actual fair market value of the property. And whatever proceeds come in during that sale, they're all yours.
Okay, Patty, I'll get to a couple of quick questions again. Someone asked a couple slides ago. You had the different options someone would have, what they could do with a note, sell it or receive the exit strategy. You just jump by it. So does the loan servicer handle all of those options?
Yes and no. So it would completely depend upon who you choose as your loan servicer. Most of the loan servicing companies actually do provide you with all of these options at an additional fee, of course. Usually they charge you a fixed amount per month, depending upon what kind of a note it is, if it's a performing or a non-performing, if it's a HELOC loan, or if it's an ARM loan. So it depends on various factors, and they charge you a specific amount, a monthly fee. But if you were to do a loan modification, I think they would charge about $100 to $150, and in order to record that in their system and change the settings so that they can issue new monthly statements and invoices for the borrower.
Okay, last question I want to make, because somebody asked if they get your contact information, which we are going to have here in just a minute. It's also on the bottom of the slides, at least your phone number and an email. But someone else asked if they can they request notes that's secured by real estate in Florida? They don't want to try to go get properties outside of the state. So I guess, can someone, if they were working with you, would they be able to tell you what state they're looking at buying in so they don't go outside of their comfort zone? Okay.
Absolutely. So we have something called a buyer's profile or a questionnaire. I don't think I have that here, but if you can just email me, I will send you a link where you can enter all of your purchase criteria, the kind of properties, the property values that you're looking for, the kind of properties, if you're looking at single-family homes, multifamilies, condos, or manufactured homes, that kind of thing, and what amount you're looking to invest in, all kinds of things. So you can give me all of your purchase criteria, and as soon as we have something on our plate, like I mentioned in this particular slide, I would only send it out to you if it matches all of your purchase criteria, and it is giving you the yield that you're looking for, or the ROI that you're looking for. And having the specific states is much more helpful. Like we have, for example, we have an investor who only invests in Texas for properties which are worth at least $150,000. We have two investors who work specifically in Minnesota. So it is entirely up to you. If you have specific zip codes, you can feel free to list those as well. So if anything comes in that matches your criteria, we don't do mass emails per se. We don't want to just put it out there and hope somebody comes in. We want to cater to investors who are specifically looking for those kind of deals. So absolutely, please do send me a quick email, and I'll be more than happy to send you the buyer's profile.
Okay, Patty, yeah, we have one more question, but I'm going to let you go ahead and finish up here in the next few minutes, and then we'll get back to that question. So.
Sounds good. So I was talking about our power team and all the various members who are involved in servicing a particular note. Please note that we do not need all of them for all of our notes. The number of people or the number of companies that you would bring in would depend entirely on a particular note and how you're managing it and what your exit strategies are. The first are asset managers. We work with our asset managers, our credit counselors, as they're also called. They act as negotiators or mediators between us and the homeowner, so that they have slightly different rules. So they can act as mediators, and they can work with the borrower, find out their intent, if they are willing to keep the property or let go of it, and what their exit strategy would be. We work with attorneys sometimes when actually in two different phases. During the due diligence phase, we work with attorneys to review the collateral files that we have, which are the soft copy at that point of time. So they go over the collateral files, and they let us know if they see any discrepancies or any break in the chain of assignments or the allonges. So we can go back to the seller. This is not a big deal if it does have some breaks, as sometimes happens. We can always go back to the seller and request the documents, and they would be able to contact the previous seller or the previous owners and get the assignments and the allonges signed for us. So our attorney helps us review these documents and kind of provide their legal advice at that point. And the other area where we would need attorneys is when the borrower is non-responsive. We are not able to, when we keep giving them calls, we're sending them text messages, we're trying to have somebody go in and talk to them face to face, but they haven't been opening their doors, and they're kind of very non-responsive, and they're not ready to work with us. So we have an attorney who we work with who would then initiate foreclosure proceedings on the property. Again, this has to be done after you have given them sufficient amount of indication and time that that you're ready to work with them, and that if they don't respond within the next 30 days or so, then you would initiate foreclosure proceedings on them. This is also called a demand letter or a notice of default. It depends on what states you're in. This is where the judicial versus non-judicial thing comes in again. But yeah, so once you send them the demand letter or the notice of default, they have 30 days to respond to you. And if they don't, you would then initiate foreclosure proceedings on them. And this would be recorded either with the county if it's a non-judicial state, or at the court if it's a judicial state. Then we have credit reporting agencies. This is more applicable for second mortgages, like we talked about before. They would be able to pull up the credit reports of the borrower, which would give us their FICO scores, their payment histories, the number of accounts that they have on their name, how many of them are still open, how many of them are closed, if they had ever been in a bankruptcy before, all kind of information about the financial situation of the borrower. It is important to get the very latest credit information because it keeps changing from time to time, and you need to know what the current status is of the borrower if you were to provide them with good options. We also work with document custodians. What these guys do is that they actually maintain a hard copy or a physical copy of all the collateral that we receive from the seller. There are very strict rules about maintaining these documents in a secure location, and these document custodians help us in abiding by those rules. The door knock servicers, we generally use them before we contact the attorney, just like our last resort, where we try to send in an actual person or an agent who would walk up to the property, knock on the door, see if anyone's living in there, try to see if they can talk to the borrower face-to-face, and try to get them to open up about any hardships or difficulties that they've been facing. There'll also be hand delivering a letter to the borrower where you would list all of your contact information and what you're trying to do and how you're there to help them through their difficulties and how they can contact you. Then we have general contractors. If you do come into possession of the property, you would need these contractors who would go in and do some kind of repairs, put some lipstick on the property and make it look good so you can start selling it on the market. Loan servicers, these are actually one of the most important parts of your power team. They're the ones who would be sending in monthly statements to the borrower. And if it's an adjustable rate mortgage, they're the ones who send the mortgage notices and what their interest is going to be for the next month based on the prime rate at the time. They would also be the ones who would be receiving payments from the borrower. There are many states which actually require you to use a loan servicer because there are many CFPB rules and RESPA rules and TILA rules that you have to abide by, and it would be a huge task for an individual investor to keep track of all of the letters that need to be sent out to the borrower and maintain it. So having a loan servicer is very important to in order to maintain or to be able to maintain a large number of notes at one time. The next part of our power team are property managers. If we do come into possession of the property at the end of a foreclosure sale or by any other means, we would require a property manager who would maintain it for you. They would make sure that the property is well maintained. They'll take care of lawn care, landscaping, and all the other good things that come with being a landlord. And if the property would turn into a rental, they would also be able to find the tenants for you, and they would collect the monthly payments or the rent from these tenants every month. And I think the fee for these property managers is very nominal. They charge about 7% of the monthly income, which is not bad considering all the time that you can save and that you can put into finding and funding more notes. So I would highly recommend using property managers even for your regular rental properties, if you already don't have them, that is. The last step, I think, the last part are the realtors. These are actually one of the first people we contact when we are in our due diligence phase. And we talked a little bit about this before as well. They give us the most important piece of information that they can give us is the 30-day quick sale price of the property. We use this particular number and not the fair market value when we do our calculations, just because it offers a worst case scenario for us, and we like to be conservative in our numbers when we are doing the calculations, just so we're prepared. And when we actually actually get the profits, or when it's time to reap the profits, most of the times our numbers are much higher than what we estimate or anticipate our profits numbers, that is. So it actually helps us in our calculations to have a 30-day quick sale price for these properties. They also look at the property condition. They do a drive-by. They take some pictures. If there's any damage to the property, especially when it comes to vacant properties, there is a risk of theft and vandalism. So they try to take pictures and let us know what the current condition is. They also give, and since they're local realtors to that particular area, they are also able to give us information about their market conditions, if it's a buyer's market or a seller's market, and what the rents are in that area. Knowing the rent is actually very important when we are trying to provide them with loan modification options. For example, if the monthly payment is, say, $300 a month, and the rents in that area are, say, $900 a month. When you're trying to do a loan modification, that would actually be very beneficial for you in your negotiations with the borrower, because you can say, look, you've been living rent-free for the past 2 years or 4 years, and if you were to pay the rent, you would have actually paid $900 a month, but your monthly payment is only $300. So that gives you a little bit of leverage when you're negotiating with them. So you can either A, increase your monthly payments to $900 a month, or B, you can ask them to make put some skin in the game and make some payments of about $2,000 to $3,000, or 3 months payment, or depending upon how you want to phrase it. So there's multiple options that you can provide to them, but knowing the rent in that area is a crucial factor in what loan modification options you can provide to them. Like I said, the realtor can tell you about the repair cost, the after repair value, and the pictures are very, very helpful too, because you can catch things on them. If you look at Google Maps, sometimes the pictures are from way back in 2014 or 2008, and that's not very helpful in learning the current condition of the property. So having a drive-by pictures are very important. And sometimes, or most of the times, the realtors are more than happy to do this for free for you, because at the end of the foreclosure, if the property actually becomes a rental, or if you're going to sell it on the regular market, the realtor who provides you with these drive-by pictures would actually become your listing agent or your seller agent. So that's a good incentive for these realtors to work with you on this and provide these services to you. So all of these guys make a great power team, and they all play their own roles. And like I mentioned, you don't have to use all of them for all of your deals. It would greatly depend on your exit strategies and what you're doing with each of them. Just a case study about the second mortgage that we purchased this note for $7,000. Here's where it gets interesting. The fair market value of the property, we had a realtor go in and provide us with an actual BPO. This was not the free service that I was talking about, but this was the, we had paid for this because we knew that the property was worth a lot, and there's, it would eventually either become a loan modification or some kind of working agreement. So when we looked at the fair market value, the property was worth around $240,000. The second lien UPB, which is the unpaid principal balance, was $17,000 on this particular deal. And that's the one that we bought. So we bought the $17,000 for a cost of $7,000. So you can see the discount right there. The living area was 3,400 square feet. It was a 6-bed, 3.5 bath. It was a huge house. It was owner occupied. We were able to skip trace successfully, and we got the current phone numbers for the owners. We made right party contact. We were able to talk to the borrower, but initially the borrower was unwilling to talk to us. They were considering various other alternatives, and they were very hesitant in talking to us, mainly because the loan has been changing hands so many times so far, and they were not very sure if we were actually the current owners. So and during this process, we actually sent them a mail campaign, which included the RESPA letter, which is again a letter that notifies the borrower that the servicer for their loan has changed to a new servicer, and they should be sending their checks or their payments to the new servicer's address from then on. And then they also got the Truth in Lending Act letter, the TILA letter, which notified them about the change in ownership of the actual note, where we were listed as the current owners. So now they have two documents, and just so we can prove to them that we are not scam artists, we actually included a copy of the actual mortgage and the note that was provided to us by the seller, which added a little bit more authenticity to the mail campaign that we were doing. There was a lis pendens that was sent to the borrower by the previous lender. Lis pendens is nothing but the intent to foreclose. This is usually recorded in a judicial court, and that was sent by the previous lender. So there is a place where you can actually add your name to it or your company's name to it. So we did just that. It was filed in the court, and then we were substituted as the plaintiffs for that foreclosure case. So after a lot of negotiations and going back and forth with the borrower and looking into various options, we also sent them out a financial statement package, something we called the homeowner's financial statement, which has questions about the borrower and their current situation, things like their current job, their income, their expenses, what hardships they faced, which led to the situation, if the hardship was temporary or if they're expecting it to be a permanent one, what they intend to do with their property and what their plans and next steps are, how they think we could help them during this process, so that kind of thing. So it's a good questionnaire that actually gives us an insight into the borrower's intent and their situation, which would in turn help us provide specific options for them that are helpful to the borrower. Our main intent is to make sure that the borrower is also happy during all of this process. We want to make sure that the borrower doesn't feel like he's being looted or he's not being scammed or anything. So we want to make sure that because from our experience, if the borrower feels like it's an unfair practice, after a few months, they would stop making payments again. So rather than risk that kind of a situation, we want to make sure that the borrower actually comes up with options on their own and they like the options that they would choose. And that's why we have an expert team here at our office who is specifically trained in loss mitigation options, and their job is to talk to the borrower and make sure that the borrower is happy as well. So after all of these negotiations, the borrower called us last month, and they were able to reinstate the loan. As you can see, the reinstatement amount is $13,500. The actual unpaid principal balance is $17,000, but then the payoff was $24,000. So given an option to either reinstate the loan or pay off the loan, the borrower chose to reinstate the loan because they had a 401k account that they were happy to tap into and get some money out of. And then, So if you look at the total expenses, we spent about $9,000, which included the $7,000 for the acquisition and then the $2,000 in legal fees and holding costs for our servicer, for our BPO, for our O&D report, and all of the other things. The total profits from this whole reinstatement were about $5,500. The first year ROI from these numbers was about 61%. And that's not all. Since this has become a reperforming note, our monthly cash flow is about $250 every month. So we not only got all of the investment back, we also have an I would say infinite ROI because there is no other cash in there. I mean, no other cash that we need to put in every month. We have an actual cash flow of $250, which would keep continuing until the maturity of the loan. The second case, I know we're running out of time.
Yeah, if we can do it quickly because we have a couple of questions I want to make sure we get to.
Sure.
After the fact, if we can just get through the last case study here in a minute or two, and then we can get to the a couple of questions and make sure everybody gets your information.
Sure, absolutely. So this case study, I'm going to go over it very, very quickly. So the first lien UPB was around $53,000, and they were past due for about 4 years of arrearages. We purchased the note for about $11,000. The fair market value was $35,000, which you can see is the property is underwater because the UPB of $53,000 is much more than the value of the property, which is $35,000. It was owner occupied. The borrower had lived in the home for almost 18 years, and they've actually been paying their taxes on time, so there was never a tax lien on it, which was good news. So this, again, was a reinstatement example where the borrower came back and said they were not able to pay the entire loan, so we gave them a reinstatement payment plan where they initially put in $5,000 just to put in some skin in the game, and they would also pay monthly payments of $523. And the best part is that this particular deal would actually qualify for an FHA 1023 refinancing at 97.5% of the FMV. So at the end of 12 months, the borrower would actually try for refinancing. Based on all of these numbers, the first year ROI was 74%, which included the $5,000 initial payment plus 6 months of payments. And then year 2 and the remaining years ROI remained 57.1%. Okay, so that was my last slide. If you have any more questions, I would be happy to answer them for you.
Yeah, Patty, we had just a couple. And like I said, I want to make sure everybody has your information here on this last slide. So any questions you have after the fact, please reach out to Patty. You email, or you can go to our website, give her a call. If you're okay with Advanta sharing your name and phone number, you're welcome to type that into the chat box on the screen, or I say your name and email address. Otherwise, you can reach out to Ader Financials. But if you type in the chat box, we'll give that to Patty as well. A couple people want to know if you had a minimum investment requirement.
Minimum, that's a good question, actually. So our purchase criteria, we try to look at deals or properties that are at least worth $50,000, because in our experience, we've seen that properties that are less than $50,000 are not usually, they don't yield very good returns. That being said, we do look at second mortgages from time to time that have much lesser requirements, investment requirements. So we do not specifically have a minimum, but we usually deal with $25,000 to $30,000. But if the property is worth $50,000 and we're purchasing at 50%, then we would need about $25,000 to $30,000 right there. And then we would also, we would also ask for the workout costs, which would include the attorney costs and the foreclosure costs and the holding costs and everything else. So it would depend on each of the deals. For each deal, we have a specific prospectus that we send out to the investor before they're able to make a decision on it. So the investment amount would depend greatly on the UPB and the years delinquent and other factors like that.
Okay, and then somebody asked, does someone have to be an accredited investor?
Absolutely not. No.
Okay.
That's the best part. Since we are a smaller firm, we do not require an investor to be accredited at all. We work with all kinds of investors, and we would provide them with at least 9 to 12% of ROI.
Okay, and that was one question. So what is the rough rate of the notes? Somebody else wondered how many notes do you sell, or I guess even buy in a typical month?
So since we buy most of the notes for our own portfolio, the number of notes we sell is actually very, very less. Sometimes, so we work directly with banks, and we try to get tapes from them so that we get them A, from a reliable source, and B, at a very deep discount. The more number of layers are added to this, the more the price is for each note. So we try to purchase them directly from the banks. And when it comes in from the banks, the rate of return is also very high. So it actually helps us quite a bit in that case.
Someone said, is the profit, if say an IRA was investing, is the profit paid once the investment is made, or is it usually done over a term of how long the note is kept?
So we have a specific JV agreement with each of the investors that we work with. So once an IRA investor agrees to work with us on a particular deal, the agreement would list out the terms of the investment. Usually it is from 12 to 18 months. It can be much longer or higher depending upon how we discuss before we get into the deal. And the payments are made on a quarterly basis. And we also provide two types of joint venture options. One is the active investor, and the other is being a passive investor. When you're a passive investor, we would provide monthly updates to you about the particular asset. We would give you a call or send you a quick email with all that has happened over the past 1 month and what progress has been made in terms of contacting the borrower or doing a loan modification or any other strategies that we're pursuing. And if you have any questions, you can always give us a call and we would be happy to talk to you. The other thing is being an active investor. We would provide a much more detailed or a comprehensive report about what's going on. And our main goal for active investors is to actually teach them the process so that they can start buying notes for themselves and start earning much more returns from the process in the future. So that would involve a little more interaction between the investor, the joint venture investor, and our company, and we would be providing them much more feedback. They can also, as a friendly gesture, they can just contact us with any other deals that they're looking at, and we can provide some kind of advice for them. So it's a more rich relationship that we have with these active investors. So there's both options, and the terms, again, depend upon the deal. But usually it's from 12 to 18 months, and the repayment or the payment is every quarter.
Okay, and the one other question: is there any states that you don't work in? Somebody asked if you operate in all states or whatnot for buying.
Yes, so we are mainly nationwide, but we do tend to shy away from a few states, especially New York, New Jersey, and Georgia, and not many states, actually, just a couple of them, only because in our experience they've proved to be very cumbersome and very expensive, and we generally do not see any notes in those particular states which give us the yield that we are looking for.
All right. Well, Patty, your information's here on this last slide, so I encourage anyone, you have any other questions, we're going to end the webinar here in just a second. But please reach out to Patty, reach out to Ader Financials, go to their website. Again, this recording will be available for playback if you want to listen again on our YouTube page. And for those of you who are listening to the playback, please give either myself or Patty a call. Patty, I'm going to pull it back here back to the other slides here in Ready Talk.
Sure. Scott, just a quick note for people who are listening and not able to look at the screen. I just want to read out my phone number and my email real quick,
Sure.
if you don't mind. So the phone number that you can reach me at is 267-571-6119. Again, the phone number is 267-571-6119. And my email address is Patty, Patty, at Ader Financials, AIDERFINANCIALS.com. Thank you, Scott.
Yeah, thank you, Patty, very much. If anyone has any questions on the IRA side, you can reach me. My contact information is here on this last slide. You know how to reach us at Advanta, 800-425-0653. My direct extension is 1123. Give me a call. We answer your questions on the IRA side. But please, if you have questions on note investing, Patty, thank you for the presentation. It's very complete. I think gave people a lot of good overview from start to finish of note investing. So I really appreciate you coming on to do that. And I would look for people maybe to see Patty on it again in a webinar here in the near future where we can dive a little deeper into some other issues as well. So Patty, thank you again.
Thank you, Scott. Thanks for the opportunity. Truly appreciate it.
All right, you're very welcome, and we look forward to having everybody on at our next webinar, our next live seminar. So thanks again for listening.